Commercial Debt Doctors is a podcast dedicated to helping businesses and business owners to achieve their financial goals and help unlock the most advantageous ways to use debt to capitalize your business. We are based in the United States, which is home to the most robust and mature debt capital markets in the world. We attempt to use the shared knowledge and experience of our many guests, friends, and colleagues to help brainstorm about the best possible solutions to certain problems and common issues that most companies face at one time or another. Whether it is a relatively young company or a mature business, no matter what the industry or geographic location, we are looking to help small to medium-sized businesses to avoid pitfalls and traps and unleash the true power of their company through proper capitalization. Each week, we will feature industry experts, lenders, accountants, attorneys, bankers, private equity professionals, and business owners who will share their real-world experience with us. We will all get the benefit of their experience and use their lessons to make good decisions related to financing and capital.
Thanks for joining us. We've got Brian Boorstein here from Granite Creek Capital Partners. Thanks for taking time today to join us.
It is extremely my pleasure.
Good. Thanks. Well, hey, why don't we start with just, you can do a quick intro of yourself. People around the Chicago M&A community, private equity community, I'm sure know your name. Probably most of them know your face and know who you are, but just take a second to introduce yourself and your firm.
So Granite Creek is a firm based and only in Chicago, at least currently. We've been going as Granite Creek since 2005, though the founding partners have worked together for 10 plus years before that. We consider ourselves a multi-strategy fund. So where we're best known for or mostly known for is investing in private equity, leverage buyouts, growth opportunities. We do that through now our second fund, and we're at the early stages of raising our third fund. But in addition to that, and if you wend your way through our website, which admittedly I haven't been on for a long time, it'll also point out that we currently manage another fund with a different strategy where we buy farmland. We are launching our second farmland fund, at least the fundraise soon. We also participate in real estate through a company that we founded called Renovo Financial. That mostly provides first lien loans to experienced rehabbers of single family houses. And we started that in 2011. I made our first loan on August 15th, 2011 to be exact. And we went from an idea and an extremely talented CEO to last year with short-term loans. We originated over $750 million across the country. So wow. It's gotten big, and as that truck drives down the road, other things spill off, and we do some SPVs of different types of real estate. So we are the majority of our countenance is for private equity, but we do a lot of other things too.
Okay. Well, super great to meet you. And we want to talk to you today specifically about how the M&A industry and private equity industry have changed. You've been doing this for a couple of years, and in 2022, and we're in this COVID era now, where we're all doing Zoom calls and everything's handled over electronically, email and stuff. But when you started, let's talk about that a little bit, and then I want to get into some specifics of how things have changed since the 80s, 90s.
Sure. Well, I realize there's an audience out there, but just while there's you, me, and Rick on this Zoom call, it looks like we're talking to each other. And so with the question of what has changed since the mid 80s when I got into private equity, first of all, the term private equity didn't exist, in the mid 80s. But, because I'm just looking at myself, to me, the greatest change is that in 1986 when I started, I was the young guy in the field. Now, with your introduction and and 35, 36 years later, I think I'm the old guy in the field, and I'm not sure if I like those changes in private. I had no gray hair. Now I've got gray hair. At least I've got hair. But so those, to take it from the top, in that time, again, really, people didn't call it private equity. They either called it venture capital, or they called it leverage buyouts. And even leverage buyouts was more coming into its lexicon was coming more into use in the later 80s. But people are calling it venture capital because there was really no name private equity, and it was a nascent investment class. I wouldn't call it the wild, wild west, because the people that were participating in the business were certainly buttoned up people, but it was much different, and it was different in every aspect. Money, the amount, there was a dearth of, no one knew what private equity was. In 86, to find deals, there wasn't this ready-made source of deals of investment bankers. They didn't even know what it was. Business brokers, lawyers, accountants, it was all new. So you sourced everything yourself. You got on the phone literally and called people. And even at that, if you got someone even was a sophisticated financial person, they had no idea what it meant.
Right.
So in one sense, there was the creation of the whole industry. And if you look across the last 30 or 40 years, the fact that it's gone from this nascent industry to a fairly stable and productive, and now a big allocation to alternative investments, and even that's gotten sliced and diced. What's come is money. Money has followed. So the velocity of money, obviously, deal sizes got larger, of course, but just everybody now knows about it and money's gone in. So if you went back until in the 80s, where you had to educate LPs as to what you were doing, you also had to educate people, what you were. There was this idea that no two private equity groups would ever buy anything from the other, right? Because what did they know that I didn't know, right? They must know something. They're getting out, right? Never even stopped to think about they're getting out because they've got a 10-year life of a fund, or they're later on into it. All these things that are commonplace to us. It was, you looked askance at someone, and now routinely. Again, because of the money, because of the maturation of the industry, people are buying, selling to each other. In fact, it's a normal presumed outcome that, hey, we'll buy it, grow it, and someone bigger will take us out.
Sure. Oh, yeah. No, I remember early in my banking career, credit officers at the bank would tell us that. They would say, I'll never do a deal where we're financing someone buying out another private equity firm, because they've already wrung out all the efficiencies. The deal's, as efficient and good as it's going to get. And what do they know? Exactly what you said. Why are they getting out? It must be something wrong with this company.
Well, again, earlier on too, that almost all of those deals were financed by and really supported only with asset-based loans. Now, the idea of mezzanine didn't exist. No one talked about mezzanine because it wasn't out there. And in one sense, if you're taking asset-based debt plus equity, and you wedge this notion of mezzanine in there, what does that mean to the buyers? It means you're overpaying, right? Again, because there was no one, until really the late 80s, that were doing cash flow loans. So you would look at the assets. Now, that's probably why if you got to 6 times EBITDA, if you got past 6 times, you would never go past 6 times EBITDA. So while 8 is your new 6, then 4 was your 6. You buy that because you're only getting financing on the hard collateral and then equity. And even at that, the amount of equity that you would put in a deal was maybe 10%. And so it's easy to get 35% IRRs when you're putting in a dime and leveraging it up.
Well, and that I want to table that for a second, because that gets into the difference in industries. Obviously, if it's asset-based loans, mostly it's industrial companies. But talk about just the size of deals. Like when you were working on deals, in the late 80s, what was the purchase price? Well,
let me take it, Phil, for another step, just to give an idea. When I first started in private equity, I was working at Golder, Toma and Cressy, which is the precursor to GTCR through many iterations. And Stan Golder and Carl Toma and Brian Cressy raised in 1980, which predated me by 6 years. 1980, they raised what was then the largest private equity fund ever. It was $60 million. Wow. So just in terms of size, there are many, many people out there, many, many groups that routinely are writing equity checks for 1, 2, 3, 4, 10 times that amount.
Right. Sure. Yeah.
So, even inflation adjusted, that was the difference of the deals. And that's why when you asset base and you're meting out smaller amounts and putting 10% equity, you can get it done. And again, industries, I think, at least back in the 80s, and I don't want to get stuck in the 80s, back in the 80s, you could look at the country in probably 3 different sectors, right? There was the Midwest, which, except Phil, you're in Arizona now, we are from, right? That was dominated by a bunch, the early private equity guys were ex-lenders, right? It was first Chicago, Stan and Carl and Brian and everyone else, and then now the Madison Dearborn guys. They're ex-lenders, and they came at businesses, asset-based loans. You're building it brick by brick, slow, but you're going to get out. You're going to make money. You look to the people who are on the East Coast. They were ex-investment bankers, and everybody is doing a big deal at that time. $100 million, a big deal. And then they're going to sell it to some other conglomeration. So they were coming at it slightly different. And then at least then the West Coast was dominated by true venture capital people, not the kind of venture capital you see now. These are more the biotech people, the people you really needed to have certain degrees to do this stuff. And they were getting into really heady science and natural sciences and probably heavy electrical engineering stuff. And as that went on, it changed. I think the internet changed that more than anything else. When the internet came to be a distribution vehicle, or at least ability to reach anyone at any time, then pedestrian business models could be migrated onto the internet and allowed biochemical engineers to get into venture business because they were taking normal businesses and just creating a new distribution. So you get the MBAs of the world becoming venture capitalists. Before, they used to be all scientists and things like that.
Yeah.
So there's a difference. And then what happened is, as that came out in the 650 area code, and now you've seen what's gone, it's burgeoning because the ecosystem it plays in. There became a dichotomy between venture capital and private equity or leverage buyouts, and then subsequently along the ways, and you and we are participants in this. Even the asset class the balance sheets got sliced up. It wasn't just asset-based loans and equity. Then mezzanine came in, and then there's people who do cash flow loans, and then there's people that do venture leasing and all these other. Now there's the new term to me is really real estate venture capital.
Yeah. So in the Midwest, it was dominated by industrial companies, right?
That's
it was mostly what percentage of deals? It was these were companies that made something. It was a plant, something you go to and see, a production facility. I remember same thing. I had credit officers tell me, like, if there isn't a plant, then I probably don't want to do the deal. The idea of doing a service-based industry of, I remember, financing like a dentist or a restaurant or something. It was like, that would have been ludicrous.
But
So,
now these days, I think if it was called 90-10 at that time, maybe there's 10% of people doing something non-manufacturing like. It looks the other way. I think if we were to able to magically go through everybody's website, I would say 90% of the people have business services, including us, on as one of their specialties. That doesn't mean anything to me, even though it's even ROIs. I don't know what a business service is. I guess when you look at, I didn't call it and say, hey, I want to get into business service. Just like people have manufacturing as one of their special. I don't know what that means, right? It could mean 1,000 different things.
Sure. So
but you're right, Phil. It was because you could touch it, you could feel it, and you weren't at that time. You weren't also competing with or benefiting from importing from China. That was also in its earlier stages. What was coming in then was cheap stuff like, my reading glasses, right? Pens, right? Now, another big thing over the 3-4 decades was it was legitimate to own or have factories in Asia, right? And they were making first bad stuff, now good stuff. And, now it's changed in the last few years because of supply chain risks and foreign country risks. But, if you stop to think about 3 or 4 or 5 years ago, we never were worried if things were getting made in China.
Sure. Well, how do you navigate that? Talk about that. Because how do you stay relevant and how do you adjust mentally? Because, some of these are industries that, you wouldn't have even looked at the deal. And now you're having to accept that, multiples are, 6, 7, 8, 9, 10 times for these service industries that maybe in the past you would have laughed at, someone even do it. So how do you stay relevant? How do you adjust?
Well, I think one of the adjustments is, and I also think that, can't underscore the importance of wherever you are in the market cycle. So in early 2022, we're coming out of an incredible bull market for private equity and venture capital. And we all know that, and we all are nervous that these multiples are nosebleed high, right? They're high, but that doesn't mean that, as I joked before, that 8 is the new 6, right? When you see a 5 or 6, it's either a small business that is localized and there's not a lot to do with it, or there's some problem. Maybe a problem is 4 or 5 types of things. And I believe that it's the velocity of money in the introduction of banks, non-banks, slicing and dicing of senior credit, of mezzanine, of preferred stock, of all these other sorts of things. Having that velocity of money has bolstered the downside of where things could be, and thus it pushes the upside, right? And also has to do somewhat a function of the amount of money you put in a deal these days. Somewhat a function of what you can do is, where in the 80s, you won't look at anything unless you get 35% IRR. Now, I'm not saying what everyone's underwritings might be, but it's 20-25% feels like a good equity, like at least for private equity or leverage buyouts, feels like an equity gain. So expectations have come down, right? Expectations come down. Why is that? Well, it's just math. You put more equity in, and you can't buy at the same price and expect to get out. That doesn't mean there's not outsized returns at times, and we've been fortunate to have them. But it's on par. It's kind of come down. How else do you adjust to it? It used to be that everybody was a generalist, and then people started getting segmented into food people or healthcare people or whatever. So you've done it by expertise somewhat. So everyone had to become expertise. And that was either you truly were a better finder and underwriter and monitorer of those deals, or you did it because you needed to do it to raise money. And it's been unspecialized, and hopefully where you made a lot of money in the leverage, made a lot of money watching, you got to add some value along the way. So I think, along the way with the value, people have gotten more operational focused. We are because we're in the middle market and we have some experience that we bring. That doesn't mean that we sit in the seat and run a business every day, though some people do that, and models are out there. But if we have to, my partners have sat in that seat, and we'll take over if we have to. So you have to add some value in different ways, and you have to have some specialization or at least some knowledge. Or, and we do this too, is you're just transactional, right? You don't sit in the ivory tower and say, God, I woke up this morning and I wanted to be in X, Y, and Z. You see it come by and you do your best to make sure you do the deep dive in your diligence, and you price and structure and diligence around what you might not know or what the industry may have in the cycles. Again, if you go back to the mid to late 80s, at that time, no one had been in a down cycle. Then in the early 90s, particularly with HLTs, there were suddenly down cycles. And then in the late, and then in the mid to late 80s, there was another down cycle. In the early 90s, a down cycle. No one had down cycles, and now you've got those scars on your back to deal with them.
Talk about let's switch and talk a little bit about fundless sponsors. This is something that's, sometimes I laugh when people, it's like this, they're a new phenomenon. They just arrived on the scene.
So in 1995, I and two partners, a guy named Jeff Wellick, a guy named David Rosen, still good friends of mine, we started something called Granite Creek Capital Partners. And that was before they had the term fundless sponsors. We were just out there, three entrepreneurial guys trying to put some deals together, haven't had experience putting deals together. And we didn't have the notion of fundless sponsors or independent sponsors for that matter.
Right.
And now, it's routine because people have the requisite skills to be able to do that. And again, with the proliferation of funds and money, those people who are entrepreneurial and standing by their own can find the money to get it done. I mean, money is a commodity. It flows to the highest return. So if you have a good deal, you can probably find the money. It's just transactionally difficult to be an independent sponsor because you need to hold the deal still, which takes you time and money, and you don't get that many swings at the plate when the seller who you had convinced it's no problem to get the money, you don't get the money. So in my experience, depending on size, the difficulty of being a fundless sponsor is certainly closing. But by and large, if a company could be attractive to a sponsor, particularly now with all the investment bankers who are very good and the brokers and the accountants and the lawyers, they know, private equity firms aren't hiding under rocks. People know where they are. So those companies that can be sponsored are sponsored. So the fundless sponsor, the independent sponsors, get those that for whatever quirky reason aren't, and sometimes are the best deals. We spend a lot of time, and I was fortunate as an independent sponsor to do a lot of those, and they were really good deals. We also find these guys because if they bring a deal and they bring some expertise, that is good insight and good leverage for us. And generally, we find them to be diamonds in the rough.
So expertise. What are some of the things that you're looking for? What are the things that separate a good fundless sponsor from one that you probably wouldn't do their deal? Expertise.
Yeah, again, it's usually some expertise in that industry, right? So we did one fundless sponsor with some really good guys called Red Arts Capitals, Nick Antoine and Chad Strader, and can't say enough about those guys. They focus in transportation and logistics, and we've seen it, but they're deep into it, and they then found an outstanding company in California, and we teamed up with them to close on that. And we made subsequent another add-on acquisition of another good company, but they knew that business, so they brought the deal. They brought the expertise, not only to find it and serve it up to us, but to then help oversee it and grow it. And then the last part is, while they are fundless, they also brought other capital as they ran around besides just the Granite Creek Capital. So they did their job. They did their job well.
Okay. All right. So we see that on a regular basis. Fundless sponsors, independent sponsors, and they've got this deal signed up, and they're not putting any money in. So,
Yeah.
I mean, is that a non-starter for you?
Well, it depends. It depends on who it is. Okay, and I'll just speak for one person. This is me. And having been an independent sponsor, having been a funded person, having been an entrepreneurial investor, either knows those things. I will tell you, or anyone who potentially wants to invest with me, it's a lot easier for me to lose my own money, which I have, than it is to lose somebody else's money. So there is a lot of risk and there's a lot of pressure, right? Going back again to the 80s, I sound like I'm a throwback guy. At that time, the CEOs, they had to leverage their house to get capital to buy in, and that's all they got. There was no ready-made 10 or 20% granted to management, for that. They had to scrape together the money to buy, and that was it. So why was that? Because they had commitment. We like to see people have commitment because we don't want to have them walk away. And generally, there are ways to do it. But if you walk away and you're in this business, just like if you're an employee, when you're an employee, your risk is losing your job, not losing your money. And that fall from losing your job could be a lot worse than losing money. So again, it depends on who you are. Yeah, we like to see some skin in the game so that it's not easy to cut and run. But you and me and everyone else, we structure it in case they do cut and run anyway.
Mm-hmm. Rick, you want to jump in there?
Yeah, I wanted to just maybe circle back a little bit just on just talking about sectors and industries. I know when we look back and think of some of the, it's the full general industry coverage, right? It's manufacturing, business services. Yeah. You get into some of the kind of specialty industries, whether it's healthcare or technology. What are some of your favorite deals that you worked on, and what were some of those industries or sectors that they've been in?
Well, I don't know if it's industry or sector, like just to not to avoid it, Rick, and maybe as I filibuster, I'll think about it. There are two truisms for me. I think two truisms in this business. One is you have a lot more fun when the deals are working well, right? So,
sure.
So whatever industry it's in, those ones that are working well, I've had a lot more fun with. The other thing you have a lot more fun with is when you really get along well with the management team. We want to love our companies. We also want to love our management team. We do take pride of being partners and friends with the management team. And if you look at the makeup of our LPs, as well as some of the other businesses and industries that we've invested in outside of the private equity world, tremendous number of them have been old partners and CEOs of us, of ours, and some have worked out, some haven't worked out. But that's fun. So the industries, I can't say that there's anything that's more fun than others. It's obviously whenever there's a customer facing business where the man or the woman on the street knows it, and you tell that, a lot of these companies we do, they say, oh, well, what do you do? Well, I tell them the name of the company. They've never heard of these things before. Yeah. It doesn't mean anything, right? But sometimes when you get into those businesses, everyone, I'll give you one that didn't work out for us. We were investors in Spiegel. When we told people we were in Spiegel, everybody was great, and everyone knew about it. Well, we didn't lose all our money, but we didn't do all that great with it. But it was fun, and some other ones that when people know of the products or the businesses, it goes without saying we've done some businesses that everybody like, food businesses, right? Manufactured food. That's great. Sure. Why is that? Food tastes good.
Yeah. People like to eat.
People like to eat, right? We do agribusiness. No one will ever hear of these companies, but they're interesting companies, and scientifically they're interesting. So,
especially when
it goes without saying, the ones that do well, you have most fun with.
Well, especially when you whether it's could be agri or it could be maybe even industrial, when you maybe a small component of a motorcycle or a vehicle, and it's right. you kind of know it where those components go, and then it's just when you learn those applications, it does make it fun and memorable, and just being able to say, hey, we're an investor in that small component that's in that much larger vehicle or or consumer
Right.
product.
And sometimes sometimes that's the beauty of the search that we go through, right? It's a smaller component of the overall thing, but it's that critical component. And when you find those things, then you said, aha, I figured it out or something. There's another funny part of the LBO business or the private equity business is, the fund managers, whenever the company does well, I did that deal or I found that deal.
Right.
When it doesn't work out well, it's, well, that management was not very good. Well,
Right.
even though the buck should have stopped with you, right? Which really does redound poorly on, your oversight of it. But there's a truism. Well, the deal, the good deals have, 1,000 founders. The bad deals have somebody else's to blame.
Yeah.
Let's talk about due diligence. How it's always it strikes me how much due diligence has changed too. Now there's like 12 different disciplines, and we're hiring third parties. How does that differ from in past? Accounting due diligence is kind of self-explanatory, but all these other types of due diligence that's done now.
Again, let me take another crack at it to go back. Certainly in the 80s, but we'll probably go back to the 3 martini lunch days when the bankers, right, were trying to figure out should they make a loan to somebody. Diligence has gotten different, more institutionalized, and some of it to me is, I wouldn't call it superfluous, but it's accuracy over precision. And again, to go back in 86, 87, 88, there were no personal computers, so you didn't have these models with thousands and thousands of lines projecting out 5 years. In fact, investment banking books or other books didn't even have projections. So really what you were doing is you were in essence underwriting the first year, and you had a lot more clarity in what the first year would or could be, because you could look at pipelines, you could talk to the salespeople about what their customers are talking about, you could see what this is. Everybody knows, and that 100% of the models that are ever put together are all wrong. Where they're wrong, you don't know, but they're all wrong. And still you structure these things. Now I understand why you structure them, because you've got growing amortization, you've got all these other sort of things, but nobody can sit here. My guess is there's nobody listening to this that 18 months ago figured out that Russia was going to invade the Ukraine on February 23rd, 2022. Forget COVID, right? So it doesn't make a lot. But what we used to underwrite, when you got a very good sense, I think asset-based lenders are really good at this too, is we would underwrite the first year. If you look at the returns in a true leverage buyout, the first year is really critical, unless, of course, you get some great back-end sale, right? Your terminal value could make it all work, but it's really making it in the first year. And that's what people were really good at, and that's where you made it or not. Again, the beauty of leveraged buyouts is if it's not working, you've got a lot of hands and strings to pull, whether you change management, you change pricing, you change sourcing, you change your manufacturing, you do CapEx. There's a lot of things you can touch. But we used to really underwrite the first year. Now we seem to underwrite, year 1, 2, 3, 4, and 5, and 3, 4, and 5 are just guesstimates at best.
Yeah.
And closing costs, legal fees, deal fees. I remember once I got called at the bank. I got called into my boss's office, and I was in big trouble. I'm not being facetious. I was actually in trouble, and the customer was upset because they weren't going to pay their legal bill for this deal we did. It was $25,000, and no one had ever seen a legal bill that big, and they weren't going to pay it, and I was in big trouble.
Yeah.
Look,
the only time that I remember in the last 35 years when the rates from lawyers did not go up was during the Great Recession. And the lawyers were complaining that, oh my God, we haven't been able to raise rates in 3 years or something like that. My guess is this year it's, the delta Y over delta X has just been tremendously high. So that has a market effect on that, particularly on the size of the deal. When you get very, very large deals, even though you should worry, it has less of an impact. So they've gone up. Another interesting thing that's come along, as we all know, is the notion of quality of earnings. That activity, which is actually done better by the accounting firms than that used to be the purview of the selling investment bank to do. Right. And they weren't really. They were probably doing the projections, but now you got the accountants in there, and that adds expenses. They would do work before, but now they do the same work plus they do the Q of E's. Now, again, to the point of it's gotten better. You get better data because they're better debits and credits guys than anyone else out there, and you get to see it. And you get sometimes you get a good Q, or sometimes they prove out an E, or sometimes you get a Q of E, and it's good. But they're out there looking at it. It's now that there's sell side Q of E's, and then we bring in our buy side Q of E's to do a Q of the Q of E. And so, there's more and more people layering on, and it works a little bit because you have to over equitize these things than you had before, and it works because what was 6 is now 7 on the way out, and it can pencil out. So yes, if you look at small deals, you can see 10, 15% of the entire costs going to transaction costs.
Yeah.
I'm sure, Phil, you remember, particularly when talking about manufacturing, you go back to the 90s, you didn't move without an environmental audit, an environment, now that's a secondary thought. Maybe you do it, maybe you don't. You don't do it on business service companies. But then everyone was doing environmental audits. Now you've got Q of E's, which is good. It's just more cost and deeper dive in diligence.
Right. And IT and all kinds of other things.
But cyber obviously is the new one, and it makes good sense because that can bring that one cyber attack, and we've had them. One cyber attack can take you to zero fast.
Yeah. All right, now now we get to have some fun. I want to hear some of the craziest stories you can think of from deal closings.
Closings. Oh, okay. I was at one closing one time that it was brought to me from an independent sponsor group, very smart guys, and then they had brought a seasoned CEO. He had run public companies. He had run pretty well-known private companies, and we were buying a nationwide chain of stuff, and talk about no money. This guy, near the end, he's kind of moving away. He's got no money. Literally, you get to the sources and uses. The final thing, it was like closed by like $100 that he was short of. He didn't have it, and one of the independent sponsors literally came out, took out his wallet, threw it up $100, and said, "Okay, I'm closing for him." Literally, because everyone says, well, what kind of check will you write? Well, no one ever writes a check. Forget cash. It was the first time I've ever seen cash in a closing table.
I love it. And closings used to be done. This is another thing that's, now you close deals. Sometimes there's all kinds of people involved. You've never even met them. And that's a phenomenon.
You remember running around the table, having sore hands, signing all these documents. Right. Now you've got DocuSign, and you never meet the people. It's just like this. First of all, podcasts didn't exist before, let alone the fact that the three of us are in 3 different places. But you remember when Citibank used to have a signer? Some guy would show up out of the blue with just with a ballpoint pen. That was it. He never saw anything. He never met anyone. He introduced himself. You didn't need to put him at the security guard system because everybody could just walk up. Then you'd walk up. Who is that guy? Oh, he's the signer, and he would sign on the behalf of the city. It wasn't even the people doing the deal.
Right. Right. Yeah. And yeah, we'd be in a conference room at one of the law firms, and everybody's there, and there'd be negotiating still going on, and people would leave the room and come back.
I'll give you another funny closing story. In 1989, I was closing a deal, and we were in New York at Wild Gottschall, and we were in the small little conference room, and it was, talking about, long time. We were there for like 3 weeks closing this deal. Anyway, wow. In the very, very large conference room next to us, with a table that, as long as, could fit in Versailles, was a restructuring going on for Donald Trump and all his lawyers.
Wow.
Well, late at night when we would go into that room, they had the really good food out there for them. We had the sandwiches. And they also left all of their information on the conference table, and we were looking at the financials at that time. It was very interesting. Lot of red in that number. And I will say, and again, it's not a political thing. It's happened to with 1989 with Donald Trump. He was a good scrambler, because if he could scramble out from those numbers and still survive and make it to be president of the United States, it was pretty incredible to see what's going on.
That's great. Well, any final thoughts, closing statements, final argument?
My final argument is for those people who are listening in the private equity, the leverage buyout, or the venture capital world, stay at it. There's always been a better return on capital than return on labor, even though we talk about the lawyers making a lot of money. If you do it right, you will not only do well financially, you'll enjoy what you're doing, but equally, if you wake up and you look yourself in the mirror every day and say, I like what I do, and as a result of that, I like who I am, it's a good business to be in, even though it's not that nascent class it used to be. It'll go on for a long time, and there are different, but don't be afraid to go one or two isotopes away from the norm, right? Private equity and hedge funds, they're not the new thing, but there is a new thing out there. I don't know what it is, but when you see the new thing, take a chance, go for it. Be that visionary to go, take your skills. They can't take that away from you, and go for it and try to do something different.
That's fantastic. Brian Boorstein, thank you for some time with us. It's always a pleasure to talk to you, and it's a lot of fun. So thanks for your wisdom and your experience and your anecdotes, your stories.
Thank you for the chance, Rick.
Thank you so much for listening to today's podcast episode of Commercial Debt Doctors. Our guest today was Brian Boorstein, co-founder of Granite Creek Capital Partners. Please visit granitecreek.com for more information. Thank you so much for listening, and do us a favor, please like and subscribe to our podcast and recommend to friends and colleagues and business owners, and they can like and subscribe as well, and we will get the word out about the Commercial Debt Doctors podcast. Thank you so much.
There he is.
Hey, Phil, how are you?
I'm good. How are you? Thanks for doing this. Rick will join in here in a second. You're going to have a snowstorm there tonight, huh?
Yeah, I can see the flakes going now, unfortunately. I think it's going to go steady.
Well, how's your day going? Good?
I did. I stole it. Phil first.
I don't have one of those anymore.
Yeah, because I stole yours. Yeah.
Now that you're doing a podcast, you can Rush Limbaugh.
Well, thanks for joining us, Brian. We'll get started in a second, but I think we got our topics. You started in the business, things were a lot different, so that's what
Hey, congratulations. You hung in there all the way to the end. Do us a favor. Please like and subscribe to our podcast. Listen on other podcast services. And recommend this podcast to friends and colleagues and spread the word. They can like and subscribe, and then you'll get alerted when we make new episodes. All right. Thanks for being a loyal listener, and have a great day.